And good afternoon. Welcome into Market Talk on this Wednesday, March 9th. Thank you so much for joining us, making us part of your day once again. I'm your host, Jesse Allen. We are live in New Orleans, Louisiana, here today as we are getting set and prepared for the Commodity Classic, the 2022 version, and excited for that. We'll be reporting from the show tomorrow and Friday, and we will be looking forward to talking with folks there and having a great time. And of course, you can find everything. MarketTalkAg.com is our home on the web. MarketTalkAg.com is where you can find us. Facebook, Twitter, Instagram, all of our streaming sources, and much more. It's all online. MarketTalkAg.com. Well, we had a March WASDE report released today. A lot of things to talk about surrounding that and just these markets in general, more volatility seen. Let's bring in our good friend Mike Zuzolo with Global Commodity Analytics joining us here today. Mike, good afternoon to you, sir. A lot of folks coming in, maybe thinking it would be a busy day just with everything going on in the markets, and you throw a WASDE on top of it. But to me, it felt like the reaction to the markets or to the WASDE report in the markets was kind of muted today. What were your thoughts?
Well, it's interesting because I know we're both traveling. You're down at the Commodity Classic, getting ready to fire that up in New Orleans, and I was over in Covington, Indiana, with University of Illinois All Day Outlook on Tuesday. And when I was driving back, Jesse, after talking to 200, farmers from Illinois and Indiana, and talking about acreage, talking about their needs this year, talking about chemical prices, fertilizer prices, diesel prices, especially seeing almost $5 a gallon gasoline in Champaign, Illinois at the pump, I started to think about, well, why is the market acting this way before the report? They're back to buying beans and selling corn and buying beans and selling wheat. That old traditional pre-WASDE report. Here we had on Tuesday news that the London Metals Exchange stopped and canceled trades in nickel because nickel doubled in price to $100,000 a ton. That's a 145-year-old exchange, and the futures exchange couldn't keep up with the market and had to cancel trades because margin calls and the leverage that we're seeing here. We saw also the idea between the wheat market and the crude oil market, the idea that the trade is getting way ahead of itself to the point where the futures market is creating an environment on both sides of the Mississippi where we can't sell cash wheat and cash corn even in some areas for March or April delivery. Elevators, commercials are pushing us out into the early summer and midsummer again because of the volatility and the margin call exposure they may have. And then you had talk late in the day on Tuesday about the Russians banning exports. And then it came out that the Ukrainians were probably going to ban exports of all kinds of different commodities. And so all these things going on, and yet the trade, had an almost $2 range in wheat because of these things, but it still seemed to just trade pre-report jitters. And I think that's exactly what it did. So this goes back to what you're talking about. Why didn't it react more to the report? And I think it was because it had baked in a smaller South American crop, and it baked in bigger wheat ending stocks. And I think the only surprise to me was that the trade was expecting a 280 million metric ton ending stocks figure on the high end for world wheat ending stocks, and USDA gave us 281.5, took us above the range of guesses on the high end. Similarly, we were, I think, the trade expecting sub 125 Brazilian soybean production. What they got was a 127 though, and so I think it left a lot of longs very disappointed. So I think we're back to where we were about 3 weeks ago, and that is the soybeans have hit a price level of that 1745 level again, busted through that resistance just a little bit, but now they need the wheat and the corn to join up with them, and we're not getting that job done.
Well, Mike, let's go through the numbers a little bit more here. You hit on a few of them. Let's start with the U.S. numbers and take a look at how these fared here today, and just any thoughts on the U.S. numbers. I know there wasn't a whole lot to necessarily look at here today.
No, I think you're right. When just one brief comment on the U.S. numbers, and then we can jump to the world ones. There's not much there except that the wheat was on the top end of the trade guesses, while the beans were in the middle of the range. The corn on the low end of the range. That's, I think, the key is what the corn did today. in both the U.S. and world numbers. And I think that made the world numbers more important because these U.S. numbers really didn't say much, as you alluded to.
All right, well, let's go over to those world numbers and talk about those a little bit more. And you mentioned some of the South America changes. You also mentioned some of those changes USDA baked in with what's going on with Russia and Ukraine. So, talk about some of these numbers a little bit more.
Yeah, we'll start at the top line number. As we talked about the wheat, went over the highest trade guess. How did USDA do that? Well, they came out and said in their very front page of the WASDE report that this global outlook this month is going to be higher production, decreased trade, and decreased consumption. And that's going to bring larger ending stocks. Well, how did they do that? Well, they took the Ukrainian exports down 4 million tons, Russians down 3 million tons, Jesse. The trade is looking at exportable supplies of 20, 30 million tons of wheat and corn between these two countries, depending on which one you're looking at and which commodity you're looking at, not 3 or 4 million tons. And so I think this just says to the trade after in the wheat market, this says after the report, there's still a lot to be told. This story is still very much unknown. The ending is very much unknown. So that's where the wheat, I think, between the drought and the southern plains and just the lack of any conclusion in terms of what USDA provided us on Wednesday, it suggests to me that we are still going to see, I think, the wheat market really play a strong role against the European wheat and the crude oil, and we still have to dial in the weather when it comes to the hard red wheat belt. So that's the wheat. The corn and beans are much more interesting because it's underneath the ending stocks numbers you're looking at here. The 300, just around 301 in the corn and just around 90 in the beans. That's not very telling because what we saw when we looked at the ending stocks that we are looking at right now versus the total demand, while the wheat total demand went down, even though we had some other countries come in with bigger exports and demand, USDA took total demand down in wheat. The corn actually went up and went up by quite a bit. And because of the fact that we saw the South American crop get cut by 8.5 million tons between Brazil and Argentina in soybeans, we actually saw a total demand decrease in soybeans of 5.5 million tons. But for both corn and beans, ending stocks divided by total demand, they're what we call stocks to use ratios, both actually went down. The corn went down to 25.2%. Beans went down to 24.7%. So this is supportive in the trade once we get through what we're going to have to deal with in the wheat market.
Well, let's talk about that wheat market a little bit more here, Mike. Obviously, we've seen a couple days here of pullback. We saw, downward moves today, and we just look at this wheat market in general. Obviously, a ton of volatility tied to what's going on with Russia, Ukraine. I know on the video feed you sent me this chart, EU versus US wheat. So tie this in and talk a little more in depth about this wheat market and just what you're seeing here after this big run up and now starting to pull back a bit.
I love this chart because it really does show you. And what's neat about this chart specifically is that when I sent this to you, it was after the report and the U.S. March wheat had not traded yet on the soft red wheat. It had a bid, but it had no offer. And we closed out, instead of 12.16, we closed out at the 12, right underneath $12. And the European wheat actually closed out just over $12 at 12.15, 12.17. And so it's really 12.16, I should say. And so it's really, really neat that we've got 12.16 against $12 for the final close once we got a settlement in March soft red wheat. So that just shows you how powerful this European wheat market is and how it really is the dog and the tail. I mean, the dog is the European market and Paris wheat, in the U.S. is the tail. Now, what's that mean going forward? I think, Jesse, what I'm looking at is Algeria was in for 500,000 tons of wheat today. Egypt is making it known that they've got about 4 months of supply at this point. Libya, their imports year to date since their marketing year started in July, up over 50% in volume terms right now. And so I think this is where this trade is still, I think, has some demand issues that are going to have to get satisfied. And yes, USDA is right. Australia is probably going to have a record crop of over 36 million tons, but they still got to get it out of the fields and they're turning wet. So I just feel as though that because of the dollar sliding and until later in the day, the crude oil hadn't slid that much, I felt like the wheat may be consolidating here and wants to wait for some more information before deciding whether it's making a high and if it's done enough demand rationing. I'll throw one other thing out to you. My biggest fear in the short term, as far as what could create an environment where the wheat does top and we really never look back and never challenge the old highs from here on out, is that peace breaks out. We have an armistice between Russia and Ukraine, and the trade starts to generate their idea then, okay, the exports are going to open up, Black Sea mines are going to be taken out, and we're going to start to see the transportation move again. And it'll be just in time for the Russians and the Ukrainians to get planted with their new crop corn and new crop oil seeds and be able to really get back to business as usual a lot faster than maybe what we're looking at here at the beginning of this week. So that's on my radar screen. But between the weather and this demand really not backing down in these Middle Eastern countries, I still feel like this could be a consolidation phase in the wheat, and therefore don't give up on the corn at all as far as its upside potential.
Mike, I want to touch on the weather just a little bit with you as well, going on that point here. And I'll pull up the last drought monitor we had from USDA. And I'm hearing from a lot of farmers, they're not necessarily worried about their inputs. You know, they may have already put some fall fertilizer on, or they're hopefully expecting to get their fertilizer. They're not necessarily worried about a lot of these other outside factors like gasoline prices higher. They're worried about drought. They're worried about getting a crop in here in the US. At least I'm starting to hear some of that rumbling as we get closer to spring planting. What are you hearing in your travels, and what do you make of how this drought monitor is shaping up in the US for spring planting?
Yeah, I agree with you wholeheartedly. I will have to say, though, I'm hearing a lot more guys, and this came at the table yesterday that I was sitting at. They're talking a lot about the fuel prices, and a lot of guys didn't lock in diesel, and I think that's a real big now in hindsight, a real big mistake. And those prices are not going to back down because we're moving towards the summer gasoline season, and the refiners will switch over now towards the unleaded, especially given the consumption and the consumer prices and the inflationary feel that you get from the retail side of unleaded versus the distillates or the diesel market. I mean, most of the transportation people will just pass on the higher prices, but it won't feel as bad and painful as unleaded gasoline at the pump of $5, $6, $7 a gallon, which I think that's really in the works here, given this import ban out of Russia and really nothing to replace it with heading into the summer driving season. So I think the fuel is an issue. I think that will turn some heads on the acreage. And it's like one of the guys said that I really respect the other day in the meeting. He said, I know you guys are talking that you're not going to worry about the high price of this and that when it comes to corn, but when you actually have to physically sit down and write that check, and it's $500,000 instead of $200,000, that's going to really work against you. So what I'm also hearing, Jesse, is that as you go from Texas north, west of the Mississippi, that's where the drought is really and guys are really almost screaming it that they just aren't going to get anything to sprout if this weather pattern doesn't shift. And the GFS model is looking a little wetter. The Europeans saying, no, it's not going to change. And so there again, we've got some volatility in this market that's allowed, I think, some longs to want to jump out and wait and see what happens.
I know one area for me I'm keeping an eye on, and I know, the old adage, plant in the dust, the bins will bust, that whole thing, but I'm keeping an eye on Iowa. I mean, that drought monitor area there is, ever expanding, it seems, and we'll see what the new drought monitor picture looks like when that's released tomorrow. Mike, I want to touch on the energy market as well with you real quick. I know you alluded to oil, and we saw oil really backing off here as we moved into the afternoon on Wednesday. I mean, we touched $130 and a half, and now we're back down, trading 108 area. What's your thoughts with everything going on with this crude market and how it's affecting gasoline, diesel prices, et cetera, right now?
Yeah, I mean, this is where the futures market's probably going to be a lot more volatile than the cash market. I think the cash market's going to just continuously stay steady, if not go higher, because of the seasonality of this summer driving season that I was talking about a minute ago, Jesse. I think the big thing that happened on Tuesday's trade that allowed the crude oil to come back and turn around was that we had heard that President Biden had reached out to some of the OPEC countries like Saudi Arabia, and they weren't even taking his calls. Well, Wednesday comes around mid-session, and we hear that some of the OPEC people like the UAE or some of the other people in OPEC in the Middle East are looking at maybe increasing production or going to the OPEC to talk about increasing production. And that's the kind of volatility that we can continue to expect. I think in the long term, it's going to be very hard for the supply to catch up for the demand with the demand until we get to maybe midsummer. And so therefore the cash market, I think, is going to be really well underpinned at this stage. The last thing I'll throw out at you is, unlike 2011, 2012, some of the other rallies that we had, other than when we had that big run up in 2005 to 2008, we didn't have the commodity index funds underneath us buying into this market until this year and last year. And they've really taken hold in this market. And you can see that on the Commitment of Traders report. We're not really adding a lot of wheat longs on the managed money. We're not seeing the corn managed money numbers go crazy. They're actually dropping a little bit, yet the market was rallying sharply. That's the index fund money. And what I think is really coming into play, maybe, Jesse, and it goes back to this nickel trade. If you have a long in the nickel trade or a short in the nickel trade, and he's an index fund and he's getting his head handed to him in the nickel trade, and he's got a basket of commodities that include crude oil and wheat, he's going to liquidate that whole basket of commodities. And I think that's something we really have to be prepared for. And this is something I'm trying to introduce to the clients and subscribers I work with, is like 2006, 7, and early 2008, before we got into a real financial crisis. That was a demand-led market, demand-led not just from a standpoint of the world economy, which we have with this pandemic and coming out of the pandemic, but also the demand-led of the commodity index funds, the long-only funds. And when they got out, the hedge funds and the managed money people got short, and it made it even worse. So this is something we got to really think about when it comes to farmers saying, I'm not going to hedge. I don't know what my yields are going to be. Like you were saying, the drought, I can't tell you what my yields are going to be. I can't hedge. I just don't think that's a smart way to go about this year.
Mike, we need to talk livestock, and looking at cattle and hogs today, we were down a little bit, but I think it was a tale of two stories with the WASD numbers. I think the cattle numbers looked encouraging, hogs maybe not so much. Pork side of things on the WASD. What's your thoughts after the report and how the livestock markets traded today?
Yeah, I agree with you on the production side, but it was really interesting. The USDA tacked on another $2 for the cash steers for 2022. And they tacked on another $6 for the hogs. And I think, Jesse, underneath this market is this HPAI coming back into the commercial flock. I really got nervous when I heard the Iowa Secretary of Ag talk this week after Sunday's HPAI was confirmed in an Iowa commercial turkey flock. And he said something very telling to me. And he said something very telling on his interview when I was listening to it. To me as an analyst, he said, this coming in this early of March, before the migratory birds fly back to where they came from, really kind of troubles me. And it could mean we're going to be seeing a lot of HPAI, and that he had quoted 6 states with commercial flocks that had HPAI. I think this could be a real big issue, not just for feed grain demand and soy meal demand, but especially for the meat market having to substitute potentially lost poultry and lost chicken and turkey flocks with red meat. So I think the more I go along, and this is kind of the end result of what we've seen between this week's volatility, Ukraine, Russia, WASD, and HPAI, is I still feel as though the first half of this calendar year is the best time to hedge, is for the grain markets, especially in the soybeans. And I feel like that the second half of the year is going to be more of a time period where the livestock producer has more comfortable ability to hedge and get some better hedges in place. So that analysis really hasn't changed, even though we've gone through some of this real crazy stuff.
Mike, great stuff as always. Always appreciate your insight. Got about a minute here. Any final thoughts you have for us? The floor is yours.
Yeah, one thing that I would say to you too, Jesse, and this is where I've stopped doing some free trials for some of the media, but I will extend yours because I really get a lot of feedback from people that listen to you and watch your Market Talk program. What I would really strongly urge you to think about is stop marketing with social media, start marketing with research again, because I think we're changing in this commodity market, in this financial market. China and Russia have a different mindset than we do in the West now. We're starting to see that they're only going to try and build upon that. So we're going to have to learn what happened in the 70s and the 80s again, and not market as much with hedge funds and market as much with social media. So think about signing up with somebody that does research so you can integrate that into your risk management plan.
Well, I know folks can reach out to you, globalcomresearch.com, sign up for a trial and learn more, give you a call, all those great things. Again, globalcom, that's com with two M's, research.com. Mike Zuzolo, Global Commodity Analytics. Appreciate the time on this Wednesday. Thanks for joining us here at Market Talk, sir. Have a great rest of your week. We'll talk to you next week.
Eat lots of shrimp down there, Jesse.
I'll do my best.
Okay.
Mike Zuzolo, Global Commodity Analytics. That's going to do it for Market Talk on this Wednesday, March 9th. Find us, markettalkag.com. I'm Jesse Allen. Have a great afternoon.